What's up, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, I want to talk about why I believe dividend-paying whole life insurance is so freaking awesome. It is just a really, really powerful financial product, guys. And I wanted to make this video because I see a lot of really bad, misleading information about dividend-paying whole life insurance. They're just trashing it as this terrible place to put your money, get this awful rate of return, which is not true. And it's just a lot of misleading stuff. And I remember when I was starting to go down this rabbit hole of infinite banking and whole life insurance, IULs, and all this stuff. There was so much information out there, and I just remember thinking, I think to myself now, like, had I not done my research into how these things actually work, I likely would have never discovered the true power of these types of policies. I mean, they are just awesome because they solve so many problems. They provide so many benefits in one financial product. That's why they call it I've heard it called the financial Swiss Army knife, because in one product you can do so many things, right? So it just becomes a really, really efficient place to put our money. Now, does that mean it is right for everybody? Of course not. And that's important. But how do you know if it's right for you or not if you don't have all the facts and information about it? If you're listening to the likes of Dave Ramsey, for example, we know that he's not a fan of whole life insurance at all. And he's just straight up lies about how these things work. And it's really unfortunate because a lot of the people that stop there when they hear someone like Dave Ramsey say that this is a terrible place to put your money, they stop there. They don't continue to do their research when in reality, this could have been a really, really good product for them, a really good choice. But you can't make that you can't make an educated decision if you don't have all the facts. So I want to share just my experience with dividend paying whole life insurance so far. I want to cover some of the, or just go over the main problems that it solves. That way you can make the best decision for yourself. Maybe it's right for you. Maybe you're going to do buy term and invest a difference. Maybe you'll do whole life insurance. Maybe you'll do both. Maybe you'll do neither. It just depends on your specific situation and your goals. So let me go ahead and share my screen. There's some specific things I want to go through here. And just covering all the all the problems that this one product solves. So it's really, really powerful. So number one, obviously, it provides life insurance, okay, to protect our loved ones in case something happens to us. This is especially important if you have a family, you got a mortgage, you're the main breadwinner in the household. Like, you have to ask yourself, what would happen to your family financially or just in general if you were to pass away unexpectedly? We want to make sure that our family is protected in case something happens to us. So, a lot of times people will do, buy term and invest a difference, and they buy term because it's cheaper on the front end, which is true. But in the long run, is it? That's a whole other video. And I'm not saying there's anything wrong with term insurance. You do get the most amount of death benefit, but it also doesn't provide a lot of these other benefits as well. So it's kind of give and take. That's why, again, it really depends on your situation. But the first problem this product solves, dividend paying whole life insurance, is it does provide life insurance to protect your loved ones. So that's number one. Definitely want to make sure we have that covered. Number two, it provides a really good savings account. It's a really good savings vehicle. That's what I meant to say. But it provides savings account growth where we're going to net 3 to 5% tax-free compound growth for the rest of our life as long as we have the policy in force. That's a pretty good savings account. If I came up to you and said, hey, there's a savings account down the street, this bank down the street offering savings accounts at 4% tax-free, all right, compound growth, and you can use the money without interrupting that compound growth, does that sound like a pretty good savings account? It does to me, and we're not comparing it to the stock market, guys. That's why, also, I've heard dividend paying whole life insurance called the and asset because you don't have to choose between one or the other. You could set up the policy, borrow against it, go build wealth like you normally would. So you don't have to do one or the other. We're going to talk about that in a minute, but really good savings account growth as well. That's just an awesome benefit. And, are we going to get wealthy on 3 to 5% tax-free growth? No, not really. I mean, maybe though, because compound interest is a pretty miraculous thing when you give it enough time. You'd be amazed at how much money that can turn into over a long enough period of time. But, again, we're not setting these policies up just for the internal rate of return, 3 to 5%. That to me, that's just a bonus. But it's another problem that gets solved, though, is saving money in the most efficient place possible. Okay, next, emergency fund. We know that we want to have an emergency fund as much as we can, but minimum is usually like 3 to 6 months. You want to have stored in an emergency fund. Dividend paying whole life insurance is a phenomenal place to have an emergency fund. I don't really use them for that because I use them more for the opportunity fund. We'll get to that in a minute. But if you need a new roof, your car breaks down or something like that, and you don't have the funds to cover it, but you have you have money saved in your whole life insurance policy. Well, you can borrow against your policy to cover that emergency. So it's a great place. It acts as a great emergency fund as well, just in case you need it. Okay. Opportunity fund. This is primarily what I use my policy for, is to continue building wealth like I was going to anyways. The only difference is, instead of having my money sit in a savings or checking account doing nothing, providing hardly any of these benefits at all, I put my opportunity money in my dividend paying whole life insurance to get that 3 to 5% tax-free compound growth, plus all of these other benefits that we're talking about. And I can borrow against my policy to build wealth. So the way I'm using it right now is a couple of different ways. I'm flipping heavy equipment, very similar to flipping real estate. It's just heavy equipment. All right. And then I'm going to be doing private money lending here very soon on real estate. So if I can borrow at 5.5% and lend it at 12, that's a really good spread, a really good arbitrage. That's exactly what banks do. They pay us 1% in our savings account, but then they go lend it at 5%, right? And they have that massive arbitrage. So it's the same concept here. But the difference is I am continuing to get that uninterrupted compound growth in my policy while I'm building wealth. So I'm essentially making money twice. And the only cost of doing that is the interest on the policy loan, which right now it's around 5.5%. For me, as a business owner, the way I think about this is a small price to pay to get all of these benefits, get that tax-free compound growth. I'm still able to build wealth. It's a small price to pay. The example I give is, one of the pieces of software I use in my business, it's $500 a month. Now, if I just stop there, you'd probably think like, wow, why on earth would you spend $500 a month on one piece of software? Well, what if I told you that one piece of software brings in $10,000 a month in revenue? Now, does it make sense? So the $500 is a small price to pay to make the $10,000 a month, right? So that's how I like to explain it. So it's a phenomenal opportunity fund. So even if you're waiting on the sideline for opportunities as well, maybe you're not using the money right now, but again, instead of it just sitting in a checking or savings account, why not have it in the most efficient vehicle possible? For me, that's absolutely dividend paying whole life insurance. Next, it can be a really good retirement volatility buffer. Now, a lot of the times too, you'll hear about tax-free retirement income with these policies, particularly with IUL also, which I am not a fan of. I've done plenty of videos on that. If you're looking at IUL, please just make sure you do your research on those things. But anyways, you can use these for a supplemental retirement income stream as well. It's not my favorite thing to do with these policies. You just have to be careful with it, not to over leverage the policy, but it can be really good additional retirement income. It's tax free because you're doing it in the form of policy loans. You could also just take your dividend in cash as well if you want, up to your basis. But it's a really good retirement volatility buffer too, though, because a lot of people are contributing to their 401ks and IRAs. Nothing wrong with that. I'm not a huge fan of them, but I can see why it makes sense for a lot of people. The issue is when you get to retirement, what happens when the market goes down and you need to take income from it? The problem is that this is what's called sequence of returns risk. It's really, really important to understand that as you approach retirement. Because if you take, let's say, a $50,000 withdrawal, while your portfolio is down 15, 20%, you are severely impacting the longevity of that income stream, of that asset to provide income. Like, it's not going to last anywhere near as long as you need it to, because you're compounding the problem. You're adding to the loss when you take that withdrawal when the market's down. So instead, you want to take your income from a volatility buffer that's not impacted by the market to give your portfolio time to recover, and then you can resume taking the withdrawals. So instead of taking income from the 401k that year when the market's down, you could take income from your insurance policy. You could turn on an annuity. You could use HELOCs or not HELOCs. I mean, I guess you could, but what are they called? Reverse mortgages is another way. But regardless, you want to make sure you have some kind of volatility buffer. But the point is here, this one financial product solves that problem as well. It can be a really good volatility buffer in retirement as well. Long-term care, this is huge for me. I'm only 35 years old. Do I need to worry about long-term care right now? I would argue yes. The best time to prepare for this stuff is when you're young. Like the younger you start to prepare for this kind of stuff, the better off you're going to be long-term. But these policies are phenomenal when it comes to long-term care because so it's called living benefits. All right. And what it means is if you get diagnosed with a chronic, critical, or terminal illness, you can access a large portion of the death benefit early and use that money for whatever you want. You could, let's say your health insurance or the long-term care insurance that you have, it's not, you're not able to pursue this alternative treatment, like they won't cover it, or maybe there's a specific facility that you want to get your long-term care at, and long-term care insurance won't cover it, or there's only so much they'll cover it, whatever. All right, there are no restrictions on what you use the money for when you utilize these living benefits. So it gives you options. That's the most important thing here. Is it gives you options to do what you need to do that's going to be best for you. All right. And it's just another way of preparing for, I mean, look, we're all going to get old. We're all on a timer here. Things are going to happen. Things are going to go wrong. Hopefully not, but things happen, right? And people get sick, and it is what it is. Medical expenses, long-term care expenses, I mean, they can be massive. So having access to a large portion of the death benefit up front, if something happens, like to me, that just gives me so much peace of mind. When it really helps me sleep at night, knowing that I have that option available to me. All right, so for me, that's a massive problem that this policy solves. And again, I'm not saying to not have long-term care insurance or anything like that, but I'm just saying that this is another problem that it can solve. Also, it avoids probate. I think this is underestimated and overlooked as well. This problem is often overlooked. Is we have these 401ks and we're going to pass on our house and all this stuff. And I put in parentheses here. This does not nullify the need for a will. You definitely still want to have a will so that your assets can be easily distributed. But the great thing about life insurance, it's such a phenomenal way to pass on wealth to the next generation, a spouse, whoever it is that you want, charity, because it completely avoids probate. It's safe from creditors, and it's income tax free. When you pass on things like your investment accounts, I mean, that stuff's going to get taxed. Not to mention how long is it going to be stuck in probate before your beneficiaries receive any of it? So it's just one of those things where it makes again, it gives you a lot of peace of mind knowing that your beneficiaries will be taken care of very quickly after you pass away. Because like once that claim is made with the life insurance company, that check is sent out pretty quick. It's black and white. Like, there's not usually any issues with it. So anyways, it avoids probate. I think that's a really big thing when it comes to like estate planning and things like that. But anyways, these are some of the main problems that this one financial product can solve for us. And, for me, it just became a no-brainer once I understood how these things work, that you can custom design them. You can custom engineer them for your specific needs. You don't have to do 100% base policy like Dave Ramsey likes to trash. My policies, I set up 25-75 split, 25% base, 75% paid up additions, and it makes the policy so much more efficient. You can do large front loads as well, like all these things, right? I'm not trying to get too technical, but I just want to point out that these things, you can customize these policies for your specific needs and get so many benefits from it. So anyways, I hope that was helpful, guys. Hope it brought a little bit of clarity to the conversation, just give you some different things to think about. If you have any questions, drop them down in the comment section below. I'd also love to hear your feedback on this. And we'll go from there. So either way, hope you guys are crushing it. And I will talk to you in the next one. To your success, Matty Ice is out.